Good evening, everyone. I'm Anita Sharma. Welcome to Market Call tonight. Our special guest is Jaime Carrasco. Good evening, everyone. I'm Anita Sharma. Welcome to Market Call tonight. Our special guest is Jaime Carrasco. He's the portfolio manager at Canaccord Genuity, taking your calls, emails, and of course tweets on precious metals, pipelines, utilities, REITs, and dividend-paying stocks. A favorite here on Market Call tonight. Our number 1-855-326-6266. Our email address marketcall@BNNBloomberg.ca. Our Twitter handle @MarketCall. Jaime, good to meet you.
Thank you for having me back, and nice to meet you.
Thank you. Where do you want to begin? There's so much going on. We just heard from Theresa May. She survived that no confidence vote. Boy, are there pressures around the world. Despite that, we saw U.S. markets close higher today.
Well, again, I keep thinking that there's a lot of complacency right now.
Right.
And I myself, along as other bond-related people that are looking at it from the liability side, guys like Gunlash, Dalio, we're saying the same thing, that it's this, the market has been driven by an expansion of debt.
Okay.
Right? So you got to look at the real economy. The economy is overloaded with debt. So now what's happening since October, when I said, as the Fed started pulling back money, they started pulling up, that leverage started coming out, right? So what we're having now since October is massive instability. So if the economy isn't as strong as people think it is, it's being driven only by debt, as everything starts to pull back, we're going to see more and more instability. And the key word that I would be worrying about is liquidity. Because it's liquidity is the problem. If you look at what happened in December, the market came down very fast. What was the high? 28,000, and we're almost 4,000 points, and it got down to 23,000, 22,000. So it was about a 10-15% decline in almost in a month.
Do you think people think the market's strong, though? We're getting headline after headline, concerns with China, concerns especially on the retail front south of the border.
This is the disconnect.
Yeah.
This is the disconnect. I was listening to one of our competitors, and their advice for the year was volatility, expect more volatility. Volatility is going to increase, but they find that earnings are justifiable, so too early to pull money out of the market. Well, I say it's time to be very cautious. I would completely disagree about that, because if earnings have been driven by debt, by buybacks, by air, as the air comes out, it's going to come off very quickly, right? And because of that, I don't think it's a time to be complacent. I think what comes next, let's talk a little bit about the 30s. Let's look at the historical parallels, because you have the bond guys. Yeah. More importantly, the monetary, what occurred during the 30s from a debt perspective, because we are at the same level. We are global debts that will never be paid back. During the 30s, it was a period of complete political instability, which we're seeing today. Populist governments, which we're seeing today. Debts that couldn't be paid back, which we're seeing today. So it creates a lot of chaos. So as an advisor, how can we look at chaos and not understand that, hey, some of these things we have to be prepared. We got to be out of the market. Right? And because of that, I don't think it's time to be complacent. It's time to take a more cautious attitude, prepare for the storm, and trim back, which is what I started saying in October.
Let's do a comparative analysis. I know you're very bullish on gold. You have been for quite some time. You're also bullish on gold miners. Of course, gold stealing the spotlight at the start of this new year. Yeah. With Barrick Gold a couple of months ago, with that merger announcement with Randgold, and now recently Newmont buying Goldcorp. If we can do a comparative analysis, why are you still bullish on gold? And I ask you this in the context of the dismal quarter that we saw, particularly October to December, when folks were running for cover. They didn't make that big play for gold. We didn't see that huge safety play for gold.
Investors aren't, because they're not being advised to. But if you compare the Dow to the HUI to gold since the beginning of October, last time I was here, we have a divergence. The markets, those are starting to return well. The safe havens are working. Smart money is going there. Many days where the bond market was coming off, the dollar was coming off, the market was coming down during December, and gold was up. I posted pictures as we went through on LinkedIn on a regular basis. Now, why the miners? Because they have the leverage, right? The miners are the ones that, as gold moves one time, the miners are going to move up 10 times, because they have the leverage on the earnings. They have reserves on the ground that are going to start to be priced in. There's the chart. Right. And it gives us a pretty good idea just with the rebound on that we've had right now, which, by the way, I think it's just a normal rebound after a correction, but we haven't been able to really break 24,000 in any shape or form. So what's more important to me is the fact that one of the things I kept talking about was the USDX, the US dollar. Well, the US dollar's sitting here about 95, 96. Then you have gold at 1,300, ready to break 1,300. So at some point, that divergence is going to break.
Well, look at that line on gold, though. It's not sexy by any stretch of the imagination.
It's not sexy, but there's a reason. You know, Scotiabank paid $800,000 in the fall for spoofing the market. I've been saying all along, and Terry Duffy, the chairman of the COMEX, a year and a half ago said, if you look at what's going on around the world, a guy like that, the chairman of the COMEX, when he says going on around the world, he's talking about systemic risk. If you look at what's going on around the world today, gold should be trading about 5,000 to 6,000, but it isn't.
Right.
And people are dismissing that fact, and they shouldn't dismiss it forever because one day we're going to see a huge price. My argument has been all along that the same forces that have been pushing the market up have been holding some markets down. And as one comes down, the other one's going to come back up because we're going to find true value of things.
Okay.
And that's why I'm bullish.
Speaking of true value, I know our viewers want to find some true value here on Market Call tonight. So sharpen your pencil and your analysis. We're going to take a break here on our program. We're with Jaime Carrasco. He's a portfolio manager at Canaccord Genuity, taking your questions on precious metals, pipelines, utilities, rates, and dividend-paying stocks. Our number. Welcome back to Market Call tonight. Let's start with an email if we can, Jaime. This one's from Tom in Ottawa. He would like to know about Kirkland Lake Gold. Your opinion of this company. You're saying in the break you like this.
I love this company, actually. It's been a great performer for the portfolio. I own it within the portfolio. It's one that I haven't pulled any money out of it. What I like about this company is that it's clearly signaling what's going to happen to the other ones. Why? Because it's a brand new mine. It was started around 2014, 2015, so it doesn't have all of the history of an Agnico Eagle, of all of the other ones. So it's been performing very well, just as gold hit bottom in 2015. And so what we're seeing is good earnings, good growth of reserves, management putting it all together very nicely, and it's showing in the price. This one is one that I haven't pulled back. We did a lot of stop loss selling in the portfolio in December for tax loss selling, sorry. And this one was one that we thought of taking some profits out, but I think I'm going to let it run a little bit longer because I expect the other ones to move forth.
Okay.
Yeah.
All right, let's get to the phones now. John in Ennismore, Ontario. Good evening. Your question for Jaime.
Well, I don't know. He was just talking about gold. I had a question for him. I just topped up my TSFA, and then I was wondering about Algonquin Power or Northland Power, or maybe splitting it and do both. What do you guys think about that? And if you want some Yamana shares, I got some you can have.
John, thank you.
Well, if you need to take some tax losses, I'll take those Yamana off of you.
We have great viewers here on Market Call tonight.
Northland Power and Algonquin Power, I own them both within the equity income portfolio. I like them. They're steady cash flow. Keep in mind, though, that within the portfolio, I have taken a more conservative stand, and I am high in cash. I'm about 30% cash. And 20% in precious metals within that. So I would not really necessarily be selling my Yamana if that's the only gold stock you have. If you have less than 1% in gold, I would highly suggest adding to hedge. However, within this one, within the pipelines, within the utilities, I like both of these because of the dividends. The dividends are there. What I like about them is that they should continue to pay dividend for quite a while, and they're also inflation hedge. One of the nice things is that within companies like utilities, they always end up passing the cost to the end user, so they're very well hedged. The downside to them, though, is that pension funds own them. So if we do get a market pullback, I expect these to come off in price because it's the type of companies that the pension funds are going to be selling first. They're liquid, they're easy to raise money with. And because of that, I have cash because I want to add more later, expecting better buying times down the ways, because I do think that the market, again, there's a lot of system risk out there. So
a lot of opportunities to buy a lot more dips in our future for 2019.
Exactly, and I don't think it's time to be buying the dip just yet. I think I would take a look at the political problems and then assess. Like, we were talking about Brexit. You have the yellow vest in France. You have the issues in the strikes that are starting to happen in Asia. Those are very populist countries. You
Getting
have
word
Huawei.
that there's going to be a federal case started agaget Huawei from the US.
That's right. Then you have Syria. You have the Middle East. and then the U.S., which is getting worse and worse. We have a complete shutdown of government now for more, it's going to be 30 days in 5 days, which is a long time. Well, I don't see that getting any better. The Democrats don't want to give him the wall. He wants the wall. It's all about a wall. Well, that's going to affect earnings, right? The global earnings are slowing down. It's going to affect everything. One of the warnings I would be looking at is look at the banking index, how much it's come off since October. It's, you know, it's not signaling a pretty picture going forward.
We got some good numbers from Goldman, but maybe we can pull that up a bit later. Let's squeeze in another call, though. Patrick in Edmonton, good evening. Your question for Jaime.
Yes, how are you tonight?
Doing
very well,
thank you, sir.
Good. Just wondering about Interpipe. I'm underwater about $4, and I'm just wondering if I should hang on to it or not. It's a core holding, and wondering about the dividend, whether it's safe and street consensus.
You bet. Thank you. I'll let you go first, Jaime.
Well, we have a $28 target on it. We like it. We have it as a buy. We're quite comfortable with it. CapEx guidance was higher than expected. It's one, again, that I own. It's one of the steady pipelines that I like. I think that, again, raise some cash, but if it's one of the utilities that's going to be paying you income over the next while, it's one that I would hold on to within a higher cash content. So yes, I would wait on it and hold on to it for the cash flow.
So you think the dividend's safe?
Yeah, we don't have much concern on the dividend. Give me 1 second.
All right. In the meantime, I'll provide consensus, Patrick. We're looking at 9 buys, 7 holds, and 1 sell. 12 months out, we're looking at a price target of $26.80. What do you think of that, Jaime?
Well, we're at $28. That's our target. So yeah, no, it's again, no, we don't have any major concerns with the dividends at this time.
Okay, excellent. Thank you. Back to the phones. Sean in Swift Current, Saskatchewan. Good evening.
Good evening. Thanks for taking my call.
You bet.
I was just wondering, is 2019 finally going to be the year for uranium? And is Cameco's dividend safe? Thank you.
You know, it's funny because I don't own any uranium and haven't bought any in a while, but I keep looking at it because it's, I find it an interesting play, and sooner or later it's going to come to life. And I think we're getting there. The fundamentals are definitely getting much better. The geopolitics are working towards it. I think once the Uranium One issue blows up and all of that comes out of the U.S., it's also going to become a needed thing within the U.S. So I do think that uranium has a bit of a start here. I would play Cameco because it's a nice steady, but I would always start investing through the uranium participation units, because there I'm just buying the commodity first, and I would probably play both. I am looking at, actually, just this week, I sat down with a uranium lithium play in Peru. So I am starting to look at what is out there, but I'm not ready to invest. Right now, I'm holding my positions. I'm waiting for the precious metals to come back to really do what they're supposed to do.
Okay, excellent. Yeah. Thank you, Jaime. We will be back with Jaime Carrasco. Good evening. Welcome back to Market Call tonight. Jaime is ready to go. Let's get to these phones. Ibrahim in Toronto. Good evening.
Good evening. Thank you for taking my call. I was wondering what Eldorado is planning these days. It's been a long time. It's been down. I'm holding Eldorado, and I was thinking replacing it with U.S. Silver Corp. I'm not sure if that's a good idea. Can you please let me know? Thank you so much, and I'll hang up and listen.
No, don't hang up. Replacing it with U.S.
Silver Corp.
What's the symbol? I don't think I know that company.
USA.
Oh, USA. Perfect. Yeah. I would do that switch in a heartbeat. Yeah. We have Eldorado. Is not one that I own. I've looked at it a couple of times, but for some reason there's something missing there all the time. We have it at a 450 with a hold. We're currently buying quite a number of stocks, so this one's one that just because it's in a hold, I would not touch. USA happens to be one of my favorite companies. It's it's one of the few juniors that actually acquired a company in this past year, right? They acquired Pershing Gold. That's attracted quite a bit of, I think going forward, it'll really be good for earnings. Mm-hmm. The management there in Blasutti and the guys there, all of the Barrick team that left when they bought that copper mine, and then they went to recreate Barrick on their own. So I've been following them since then. and they keep delivering. They're building a beautiful, beautiful business. It's currently well priced, really good entry point. So yes, I would highly recommend that switch.
Do you see more M&As in the gold sector moving forward after these
Definitely.
powerhouse acquisitions?
Well, I think that M&A was a bit of a, I don't like the big boys. I don't like Barrick. To me, they're fat companies with just bad management. The management's been paying themselves quite a bit. I like the streamlined ones. I like the new mines. I like go back to 1995, I'd rather be Microsoft than IBM. That's the sector that I'm looking at. The companies that understand they're slim, that they've made it through. If you compare the big boys, all they've been doing through this period is actually selling assets. All of the companies we're on the portfolio are producing at very low prices. So they're ramping up production, buying companies, or getting more profitable, getting leaner and meaner, and they're going to have massive leverage to their earnings going forward. That's why I don't even look at the Barracks, at the Goldcorp. And I understand why they're merging, right? They need to survive, and they've done everything they can to sell off as much as possible. They will make money on the reserves on the ground, but I want to have earnings, reserves on the ground, good management. Actually, it's 4 criteria that I look at. Good management, low cost of production, high reserves on the ground, and in geopolitically safe areas. That's the most important one. Right, if you have those 4 components and you can build a portfolio around it, you have a really good portfolio. All
right, we're going to switch sectors. Bring in Vern from Edmonton. Good evening. What's your question for Jaime?
Yeah, thank you for taking my call. Jaime, I was just looking at Ford today. It dropped off about 55 cents a share, has a pretty good dividend, and I'm wondering, is the dividend safe, and is this a good time to add to Ford?
No, it's not a good time.
I'll hang up and listen to your response. Thank
Perfect.
you so much.
In my opinion, it's not a good time to add to Ford. To me, Ford is a really good bellwether of what's happening in the North American economy. Are people going to be buying cars as interest rates start to go up, as everything starts to slow down? If anything, I think I would be more concerned about the dividend going forward. Go back to 2008. I would look at all of the companies that kind of had troubles going through in 2008, and Ford was one of them. Have they structurally done what they need to do to make it to go forth? I think they're in a challenging period, and because of that, I wouldn't be looking at the motor companies.
Not even GM with their massive restructuring underway.
Nothing.
Moving towards becoming, they want to be known as a tech company now.
Well, that's even better. Why not buy a tech company instead of an automobile company that wants to become a tech company?
All right.
The only tech company that is an automotive company is Toyota, right? But again, even there, if you look at what's going on with the global economy, their earnings are going to be soft, so I wouldn't be looking at them for a while.
Okay, back to the phones. Nick in St. John, New Brunswick. Good evening.
Hello. Good evening. Great show.
Thank you, sir. Thank you, Jaime.
Can I get your opinion on Crescent Point? I own a higher price. I wonder if he ever recover. And can I get the street concept too, please? And hang up and listen to you.
All right, thank you, Nick.
Crescent Point is a company that I've owned in the past for the dividend yield. It's one that I've been quite happy with, but I don't own it anymore. I don't have it. We have it as a speculative buy currently with a $7 target. My concern with the Canadian oil sector is more the fact that there's too many issues that have to be resolved in terms of getting our oil to market. We haven't done anything in terms of building pipelines to get to Asia, and the only buyer for our oil is the U.S. because all the pipelines go north-south. I like the pipelines because they're monopolies. We're not building any. That's where the energy, the clean energy people, the lobbying has been great in that we're not building any, but now we have the pipelines or monopolies. But there's nothing going east-west. That's a concern. And because of that, Canadian oil right now, and I think it's going to continue to trade at a discount to WTI, West Texas oil, and global oil, right? The only area where we have North American oil being sold paying Brent is the Newfoundland oil that's being shipped to Europe. But otherwise, I'm very concerned for the energy. And
even moving through 2019.
Even moving through 2019, because we need some political leadership in terms of getting these pipelines built, right? I personally think that we need something similar to the Trans-Canadian Railway. It should be the Trans-Canadian Pipeline to be built today in the name of the Federation. Because why is Ontario buying American oil that's being refined that they bought from Canada at a much lower price, and then we're buying it back at a premium? That's silly when we have the resource. So to me, I think it's a political issue, and because of that, I'm shying away from the Canadian oil. I like international oil. I think oil as a component is a small percentage of the portfolio. But again, there, it's the politics and everything that's involved.
All right. And Nick, consensus-wise, we have 10 buys, 9 holds, 1 sell, and a 12-month price target of $7.97. It's time for another break here on Market Call tonight. We're coming back, though, with Jaime's past picks. Stay tuned for that. Welcome back to Market Call tonight. We're with Jaime Carrasco. Let's get to your past picks now, and we'll start on a very strong note here. Agnico Eagle doing very well for you.
Agnico, I think, is going to be a company. I sat down with them around Christmas. This company is going to be fully self-sufficient by 2021. So they won't need to raise any money for all the projects going forward. It's one of the few companies that has increased its dividend, has a dividend. And all of that extra cash flow will continue to go into dividend. Another thing that I like about the management is that they have a really good attitude towards the dividend. Mm-hmm. So I think as their profitability starts to really kick in, it'll be really good for the dividend.
Okay, let's get to AltaGas now. Here, you're under a bit of pressure. You're in negative territory.
I am in negative territory, but again, it's one of those that I'm going to be buying with more cash later. But I did take a position because the price had gotten quite low, so we did buy a little bit in October. But again, it's 25% of what I want to own in the long term, and I think it's a good one to start to have nibbled away. They did cut the dividend, but they've also reorganized everything, and we're pretty comfortable with the guidance going forward. It's one that we like as well. I think it's good, one of the good cash flow payers that I can build on going forward.
All right, speaking of cash flow, you're sitting in a lot of cash, and that seems to have paid off for you, I guess. You're relatively even. You're net even. You're down just slightly. Wow.
Well, 5%. I think I'm going to stay in cash for quite a while. One of the things that people have to understand is systemic risk. Yeah. In 2008, it was a liquidity crunch. Liquidity means that we ran out of buyers, right? And that's important to understand that in today's market, 70% of all trading is being done by computers. What happens when they decide to sell? Who's going to be buying, right?
Are you concerned by the algo trading?
Of course I am. Yeah. That's not a market anymore. A market is you and I deciding on what Bell Canada is. What we have today is algorithms working with money being printed by the Fed that's deciding on where to buy. Okay, warning. You don't have a meeting of governors on Christmas Eve as Mnuchin did. Mm-hmm. The market doesn't run up 1,000 points on a very liquid market for nothing. Like, these are warnings that people should be looking at, and people in the business should be understanding, hey, this isn't normal, right?
And they're trading on the noise, too.
And they're trading on the noise. It's all noise. To me, we're getting into very dangerous times, and it could come down very quickly.
All right. Well,
I'm happy to hold cash.
You're happy to hold cash.
Because then I'll be spending my...
When do you see yourself deploying that cash, though? When do you see that working for you? Because I would think that clients at some point are going to say, hey, where's my money working for me here? I don't see clients being too happy with their brokers having them sitting in cash for too long a period.
Okay.
Where's the fine line there, Jaime?
That's a good question, because the calls that I've been getting, people are starting to make the disconnecting greed versus getting my money back versus, wait a minute, something's wrong, right? Mm-hmm. So the questions are starting to pop. Now, it's not the 60% of the people, but 10% of the investors that have been listening to my message are kind of all of a sudden saying, hey, wait a minute, there is volatility. Maybe this is worse going forward. And for some reason, the Fed has never been able to tell us. What was Yellen saying, right before she left? Not in our lifetime are we going to have another recession, right? This whole thing with the Phillips curve. I have knew my work better. Who knows, right? I think everything is in flux.
And then you have Powell coming in with all the mixed messaging.
Right, and then you have Trump. So I don't know, if that doesn't concern people enough to raise some cash, well, I think they're going to suffer because of their greed.
It was a key headwind closing out 2018, but do you see that persisting? I mean, we seem to be getting some positive news on the trade front between China and Huawei, this alleged federal prosecution of Huawei.
That's not good news.
Notwithstanding, that's true. And then you get the noise, if you will, from Brexit. But there was a lot of, we did have a bit of a rally coming into 2019. Is that sustainable? Goldman Sachs earnings coming out not bad?
Well, I don't know. JP Morgan's earnings weren't that great, right? So JP Morgan is the king
Bank of America did okay
of the futures trading. Front. So I would see that as a key concern, because they are first of all, JP Morgan has always been the banker for the government. There is a disconnect now with Trump in government and the Fed. There's a bit of a fight going on. That would be of concern to me, right? Again, I tend to analyze things by looking at where the pressure points are. And there's a lot of pressure points. If you start to put a list together, you have the politics, you have the economics, you have currencies. Currencies are in flux. What are the Chinese going to do, right? The Chinese cannot support a massive strike, any kind of social. The real thing, at what point does China pull the plug on the U.S. dollar? It's already being discussed. Look at the currency trades that are happening in Asia. Asia is de-dollarizing very quickly. At what point does the balance switch and it becomes an avalanche? Well, that's inevitable because, again, go back to the 30s. At the core, not of the 30s, why is it so important is because what guys like Ray Dalio are saying, what I've been saying, is the end of the monetary cycle. And that is a very traumatic time, but it's also a period, like the Chinese write the word danger, crisis and opportunity. Why? Because as the power shifts from the pound to the dollar in 1933, the prime beneficiary was the ultimate form of money. And what is the number one rule of power? He who holds the gold holds the power. And we know for a fact that China's sitting right now on 18,000 tons that have transferred from the west to the east because everything was resmelted from pound bars to kilo bars.
Yeah, I read some report where it was Russia and China were really stocking up their gold.
Well, Russia is over 2,000 tons now, right?
Okay, let's leave it there. Fascinating discussion, Jaime. We're going to take a break here on Market Call tonight. Thanks for our viewers' calls. Our number, get them in, 1-855, get them in, 1-855-326-6266. We're bringing you back into the fold next. Welcome back to the phones. Ray in Oakville, Ontario. Good evening. Your question for Jaime.
Yes, hello. I'd like to get Jaime's thoughts on Franco, Nevada. Thank you.
By your voice, so I don't want to assume, it's the perfect company for older people. This is the anchor for anybody that comes into my practice. When we're setting up one of those income portfolios, as a hedge, I would have Franco-Nevada in there. If you look at the long-term chart, if you can bring up the long-term chart.
What do you want, 5-year or 10-year?
5-year, 10-year, whatever you want, because it's been a steady climber. It's completely broken away from all of the gold companies. It's paid a dividend all along. It's one of the best streamers in the world. It was set up by Pierre Lassonde, one of the mind builders of Canada's who's who on the business side. It's a really good company. What I like about this company is that the dividend is tied to the price of the commodities, so it will grow over time. Why do I like these companies for dividend? If history repeats, as I think it will, as we get in the 30s, the best investment was Homestake Mining and Alaska Juno. As gold, before the monetary reset, gold's sitting at 7 and all of a sudden it's trading at 35. Well, the producers are producing at 5. So before they're doing a $2 profit, all of a sudden they're doing a $30 profit. All that turned into dividends. Through the depression, through the worst of the depression, as that occurred, the gold companies were paying out about 10% to 15% dividend steady. Franco-Nevada, the formula of what it is, will be paying out dividends to those levels if we get what I think we're going to get, which is a monetary reset. By the way, how do we pay all of these multi-generational? I love this Ocasio-Cortez. What do you think she's going to say when she figures out that she's and her grandchildren are on the hook for all of this debt? Their only way forward is to devalue the currencies under which they're done. That's what happened in the 30s. And you can only devalue currencies against one thing that we can all trust as money for 4,000 years: gold.
Okay.
That's my bet.
All right.
That history will repeat.
All right. A gold bull here at Market Call tonight. Let's get to a tweet now. Mitesh, he wants to know about Canadian Apartment Properties REIT, or CAP. He wants to know about this one, and also housing affordability effects on occupancy rates moving forward. How are you on the real estate
That is
side?
a key concern, actually. There is a lack of rentals. They did a money raise just December, November, and I participated in it because it is one REIT that I like rentals. I've mentioned that on the show a couple of times. I allocated a little bit of cash into that because I do think that we have a problem on the rental side. You know, I have an apartment here downtown. The chap that's renting it can't afford it. right? But it's not big, right? So I'm wondering, how are young people going to be able to afford anything? They need to be able to rent.
Forget about buying. They can't even rent, you're saying?
Well, they can't get the down payment because
so
everything's going up so much. So they need to rent, but there's no rental units.
Right.
Right. And because of that, I think rental need has to be satisfied. And so the rental market is one area that I think it's quite well supported no matter what happens throughout the economy. And that's why I located a little bit. And Capreed was the one that I bought.
Is that a Toronto-specific story, or are you seeing a bullish situation across Canada?
On the rental side, the lack of affordability, it's a North America-wide thing. Okay. People don't have the money, and we've just had a massive rise in prices, right, because of cheap interest rates.
Let's go back to the phones. Nizar in Scarborough, Ontario. Good evening. Your question for Jaime.
Hi, good evening, Anita.
Jaime,
gold bullion has been touching $1,300. May I have your opinion on XGD, the equity basket of miners from iShares? Is it preferable to have a basket of miners in your portfolio rather than an individual stock in view of gold's volatility? And in light of your comments that you prefer holding cash in these uncertain times. Thanks for taking my call.
Thanks,
Those are really good questions because it addresses the one issue. I don't see gold as a company or an investment. I see gold as cash. To me, if I'm sitting on a lot of cash and I want to diversify my currency exposure, and I have clients that will hold US dollars or euros because they happen to travel there, gold I see in the exact same way as money, right? Gold and silver, the bullion. The speculation is in the companies. So would I buy the ETF? Yes, if it's the only thing I'm going to own, that's not a bad choice. However, for somebody like Nizar, I think Franco-Nevada would be a better choice because there at least you're getting a dividend. It's not the volatility, but you will get the upside. So my attitude is to build a portfolio around the companies that I'm going to own, but starting with blue chip and then work down to get the leverage on the way up, like America's Silver's at the bottom of the spectrum. But Agnico, Franco, First Majestic, right? All good companies to build around.
Because they're satisfying your criteria that you mentioned earlier.
Correct. Kirkland Lake, right? They also have a dividend, which you're not going to get with the XGD, right? So, yeah, if it's the only thing that somebody can afford to buy, yes, it's a good choice. But I think there's better choices within the considerations and the speculation. Cash and gold should be viewed as the same. Preservation, you're going to get your money back. It'll be there after 5,000 years. I don't know about the Canadian dollar, but I can tell you that that bar of gold or that gold that you've put through Sprott or whenever is going to be there.
How much of your portfolio should be in a gold cash situation? 20%, 30%?
Well, right now I'm sitting on 20% in companies. Within the cash, that 30% in cash would be about 10% in physical gold. For some people, but I've also been buying some convertible bonds because I'm also trying to get the income, trying to get cash flow. So convertible bonds and short-term paper.
Excellent. Thank you, sir. We are with Jaime Carrasco, Portfolio Manager at Canaccord Genuity. We are taking your questions on precious metals, pipelines, utilities, REITs, and dividend-paying stocks. Call us toll-free, 1-855-326-6266. Welcome back to the phones. Harry in Calgary, good evening. Your question for Jaime.
Jaime, appreciate you guys taking my call. It's with regards to a small cap stock up in the Val-d'Or area. I've got my pros and cons about it. It's QMX, and the pros are being its land package, its drill results, and a working mill. But at the same time, I'm having problems with the share number. I wondered if you can give me any input and what you think about it.
Well, I hope you participate in the private placement they just did, because I did. I like this company. It's in Val-d'Or, like he said. Everything is there, working mill, great reserves on the ground, getting things going. It's interesting because at Canaccord, I participated in 3 private placements in the gold side in November, December. Everything got sold out. So it's a clear sign that institutional money is starting to come in. Everything went over, was fully allocated, and QMX was one of them. And it's a company that I'm actually quite impressed. It's in Quebec, and I did it also as a flow-through.
Okay.
So it came through with a flow-through, so clients will get a tax break on it, and it's one that I want to hold long-term.
Excellent. Thank you, Jaime. Earl in Baddock, Nova Scotia. Good evening. Your question.
Good evening, Anita. Jaime, in your opening statement, you made the drastic comparison of the current situation to the 30s. That's a bit scary. And since October, you have been suggesting that people reduce their equity holdings and increase the cash position. Which sectors would you suggest that the average retail investor, which sectors should we vacate first, and are there any that we could hang into for a little while longer? And how high would you build your cash position to?
Okay.
Thank you.
That's a great question, Earl. Now, the answer to that question lies in what I did in the summer and how I positioned clients. The first thing I did was analyze the cash flow that the dividend income portfolio, which is somebody like Earl would need, was delivering. Then we reorganized in a way that we raised cash, so we went up to 30%. We're sitting in about 25% cash right now. Some of that is sitting in convertible bonds, so that gathered yield. So it's companies that I think are going to do well, and eventually they'll start trading like the stock. That's why I like the conversion. Then we reorganized the yield companies in a way we actually ended up getting almost the same yield that we had before the correction. Within the sectors there, what I want for somebody older is the cash flow. So I'm looking at pipelines, utilities, REITs, but I've just reduced the content because it's all companies I like that I want to be buying. I don't know which one comes back first. My concern is they're going to go down if the pension funds start selling. So that's why I want to have the cash and wait. Once the yields get good enough that I can build cash flow, then I will add, like AltaGas, even though they did cut the dividend. But long term, I think the company is going to deliver good capital growth as well. And it's still paying a cash flow. So that's how I would organize it. And I would definitely recommend the hedge of the precious metals because that's, and there as well, you can get dividend with if choosing the right companies. Within that area, Agnico, Kirkland, Franco, they're all paying dividend. And actually, they increased their dividend last year.
Okay, let's squeeze in one more call very quickly if you can. Mike in Annisville, Ontario, I know you're standing by. Good evening.
Yes, good evening. Jaime, just a question regarding Enbridge. I've held Enbridge, ENB, for a number of years. They seem to be a really solid company in dividends, and I just wondered maybe what the consensus is and what your thoughts are on that company going forward as far as their forecast, maybe a dollar value, the target that you're looking at on that.
Innisfil. I'll be driving by later on my way to Collingwood. Enbridge is one of the companies that I'm holding within the portfolio. I'm very comfortable with the cash flow, even though it's pulled back in price. But again, it's one that I am expecting to buy more later. Enbridge is a really good example of 2008 because in 2008 I did the same thing. I raised cash early in the year. By the end of the year, Enbridge was, I believe, if I recall correctly, had an 8.5%, 9% dividend. When everybody was selling in December, it was trading at about about a 9% dividend in 2008, and it had started the year at about 4%, so almost the same environment. At that point, I was quite happy to be buying when everybody was selling. So Enbridge is one that I'm very comfortable with. We have it as a buy with a $52 target, but having said that, targets will go out the door if we have a liquidity crisis and pension funds start selling because they become scared. Pension funds, mutual funds, all of this money that's sitting invested right now that hasn't even moved out, I'd rather be moving out now and get in when they're coming out, right? In 2008, the bulk of the selling was that in December, not in January. So again, I think it's, people are predictable. Okay. And by the time the fear kicks in, it's too late. I'd rather be early.
Okay, it's time for us to take another break here on Market Call tonight. Our number 1-855-326-6266. We'll be back with Jaime. Time now for Jaime's top picks. Let's start with Metalla Royalty, Jaime.
Metalla is a company that I bought an IPO for myself and just one or two clients because I like the names of the people that were going in there. It's owned by very, very solid people that I followed over the years. They did a money raise just in December. This is another one of the ones that I bought. And there I got in with all of my clients. We fully participated. It came with a warrant, which was a great. This is an early Silver Wheaton, right? It's an early royalty. They've been adding projects. The cash flow's already kicked in because 3 other projects have already started paying back. They have 29 projects. 3 more kick in this year. They just raised money to buy another cash producer. So what we're going to get out of this is acceleration in cash flow going forward, so the dividend will just build. And that's what I want. Plus, it'll have the capital appreciation. It's well managed. I believe Rick Rule took down a huge chunk of the money raised. So more good money came in. Good, smart people are backing this company, and it's one that I have quite a lot of. I think it's going to do quite well within the portfolio going forward.
All right, and you're quite bullish on India as well via Fairfax, Pramotsa.
2 plays here. One of the things that I've been doing in the income portfolio is I've been trying to make sure that I hedge my currency because the Canadian dollar, if I'm correct and we're tied to the U.S., the Canadian dollar will come down. By the way, gold in Canadian dollars tonight's at 17.80, right, because of the Canadian dollar. When gold was at 1900, the dollar was almost par to the U.S. dollar. So again, I want cash flow from outside to hedge the cash flow. I also wanted to get rid of some of my North American financials. That's why I like this. I'm getting the currency out of India because I think Asia will have the big currency adjustment against the U.S. dollar in the currency reserve shift that I see coming. And India, what I like about this company, Prem Watsa, the Canadian Warren Buffett, it's like buying the financial sector in Canada in the early 60s. Did you know that only 5% of homeowners in India have home insurance?
Oh, wow.
Massive growth, right? And that's where the income is going to go. So I'm very comfortable holding on to this, as well as other Asian plays that part of that portfolio.
And massive growth in a lot of areas with that burgeoning middle class. And finally, this has been the theme for your hour.
I continue to recommend that people raise cash, maintain cash, and wait for better buying days. I don't think this market's going to, we've had a massive drop. We're just seeing the first rebound. If it turns, prepare to run, right? Because it's going to go quickly without any liquidity there, right? The Fed has pumped in a lot of money. A lot of the messages that I'm hearing from the Fed doesn't know what they're going to do, right? They're dropping the Phillips curve. All along, I'll be saying, well, that's, you might as well go to a tarot card for. It doesn't really matter, right? All they've been doing is printing money. That's how they've been solving. What are they going to do now? We've gone to almost 240 trillion. We're going to go to 500 trillion next time around, and the next recession's coming. We can't avoid it.
There's a generation of traders that only know QE.
Exactly. Yeah.
It's a scary prospect for them in these times of tightening.
And funny you say that, because one of the reasons why I'm so bullish on gold is because when I started as a bond trader in the late 80s, it was the last generation of bond traders that had worked in a gold standard that taught me the business. So they taught me to think very differently than the guys today, right? To them, it's all these algorithms, and I don't really understand what they're saying half of the time.
Very quickly, do you see more rate hikes on the horizon this year from the Fed?
I don't know about the rate hikes. I think the bigger problem is at what point do they start printing again, because they're like a monkey with an on-off switch, right? So it's off right now, but it has to go on if everything starts to slow down very quickly.
All right.
And what do we do then?
We'll have to leave it on a question mark.
Follow the yellow brick road.
Okay, follow the gold. All right, sir. Very nice to meet you.
Likewise.
Riveting conversation. Thank you.
Thank you for having me.
You bet. As always, folks, consult a qualified financial advisor before making any investment decisions. Thank you so much for your calls tonight. Hope you'll join us tomorrow, 6 p.m. Eastern. Take care.